Now let's look at debt securities. We're going to be looking at bonds. Remember earlier we talked about equity securities. People who own stock own the company. They have equity in the company. People who own bonds, people who own debt, have loaned money to the bond issuer. So the bond issuer, the company, or the municipal government or the federal government, whoever issues the bond, they are borrowing the money. So the issuer is the debtor and the investor is the creditor. The first thing we want to talk about would be maturities. Every bond, when issued, will have a maturity. Now, that is when the bond will reach the end of its lifetime, when the bond matures. Now, maturity value is also known as par value, is also known as the principal amount, is also known as the face amount. So any of those terms could be used, and they all mean the same thing. So the maturity value, the par value, the principal amount, and the face amount all mean the same thing. Unless you're told otherwise, the maturity value on a bond is $1,000. The par value on a bond is $1,000. So we could have a bond issuer issue a 15-year bond, or a 20-year bond, or a 30-year bond, and those would be the maturity periods. At the end of that period, the bond would mature, would be redeemed, and the bond would no longer exist. Now, there are three different types of maturities here. There's a term bond, a serial bond, or a balloon bond. A term bond. This is when the entire principal would be called at one time. So we might have a corporation who issues $10 million worth of bonds, and the entire bond issue will mature in 30 years. That would be a term bond. The entire bond issue would mature at one time. Or the issuer could issue a serial bond. A portion of the bond would mature or be repaid over several years. Maybe we have an issuer, a corporation, who sells $10 million worth of bonds. $3 million of those bonds mature in 15 years. Another $3 million matures in 25 years. And the balance would mature at the end of 30 years. So here we have a serial of maturity dates, different maturity dates. Now, the reason a bond issuer would do this is to reduce their interest cost. The bonds that have the shortest maturity period would have a lower interest rate paid. Bonds that have the longer maturity would have the higher interest rate paid. Or a bond could be issued with a balloon maturity, where the principal, the majority of the principal would mature at one time. Big balloon payment. Okay, the principal repaid over time with the majority paid at the end of the balloon period. Maybe we issue $10 million worth of bonds. $2 million of the bonds come due in 15 years. The balance, the $8 million balance, comes due in 25 years. So the majority comes due at one time in the form of a balloon payment. Now, when an investor buys a bond, what's their objective? What is an investor looking to do? Investors buy bonds for income. They buy bonds for the interest income. So bonds will pay an interest rate. This interest rate is also known as the stated rate. It's also known as the nominal yield. It's also known as the coupon rate. Now, the interest is calculated annually as a percent of par. The interest is paid semi-annually. So let's say we have a bond, a 7% bond. This bond pays 7% of $1,000, par value, $1,000 yearly. So 7% of 1,000, this bond would pay $70 in annual interest. Now that interest is paid semi-annually. I divide that by 2, and the investor would receive $35 in bond interest every 6 months. Now folks, please be sure that you know all the different terms that stand for the maturity value, you know all the different terms that stand for the coupon rate. So maturity value is also known as the par value, also known as the principal amount, also known as the face amount. The coupon rate is also known as the interest rate, also known as the stated rate, also known as nominal yield. These terms will be used interchangeably on the exam, so know the different terms. Bond pricing. Bond prices have an inverse relationship to interest rates, which simply means if interest rates were to go up, the price of existing bonds would go down. If interest rates go down, price of existing bonds would go up. So bond prices have an inverse relationship to interest rates. Let's say we have a bond priced at 94 1/4 points. 94 1/4 points. And we want to turn this into a dollar amount. How would we do that? Well, I would take that 1/4 and I would turn it into a decimal. 1 divided by 4 is 0.25. So the bond is priced at 94.25 points. Each point is worth $10. So I multiply that times 10, and I find that a bond priced at 94 1/4 points would be priced at $942.50. Now that bond is priced below par. That would be a discount bond. That would be a discount bond. Price below par would be a discount bond. So interest rates have gone up since the bond was issued, and the price has gone down. What if a bond instead is priced at 102 1/2 points? I want to turn that into a dollar amount. What do? First thing I do is turn the fraction to a decimal. 1 divided by 2 is 0.5. So 102.5, each point's worth $10, multiply times 10, 1,025 would be the dollar price of that bond. Now that bond is priced above par. That bond is priced at a premium. Interest rates went down since that bond was issued. Therefore, the price went up. Premium bond. And finally, if I have a bond priced at 100 points, each point is worth $10. I multiply times 10. I find the price of that bond is $1,000. That bond is priced at par. Priced at par. Now let's talk about yields. There are 4 yields that we're going to deal with as it relates to a bond. There's the nominal yield, the current yield, the yield to maturity, which is also known as the basis, and the yield to call. Now, I don't expect them to ask you to calculate yields other than maybe the current yield. To calculate the current yield, I simply take my annual income divided by the current market value. Annual income divided by the current market value is my current yield. I don't expect them to ask you to calculate any of the other 3 yields, but they will expect you to know the relationship of yields to one another. Now let's take a look at an illustration where we're going to compare bond prices to bond yields. What's the relationship of bond prices to bond yields? We're going to go back to my old friend, the seesaw. We're going to start with the seesaw flat. On the left-hand side of the seesaw, we're going to see the price of the bond. On the right-hand side, we're going to see interest rates in the marketplace. Now, in the very center of the seesaw, we'll see the nominal yield. Going to the right side of the seesaw toward bond is priced at par, and all four of those yields would be the same. So if I had a bond priced at par with a nominal yield of 4%, then the current yield, the yield to maturity, and the yield to call would all be 4%. Now, let's change this seesaw. Let's say that since the bond was issued, interest rates in the marketplace have gone down. So the right-hand side of the seesaw is going to go down, so interest rates have fallen. What happens to the price of the bond? Left-hand side of the seesaw is the price. The left-hand side is going to go up. So here we have a price above par. This bond is trading at a premium. We have a premium bond. Now, let's take a look at the relationship of the different yields to one another. What happened to my yields? Well, the nominal yield is in the center of the seesaw, so it never changes. But current yield, yield to maturity, and yield to call, all of those will go in the direction of interest rates. So current yield will fall, yield to maturity will fall, and yield to call will fall. Now, which of those four yields will fall the most? Yield to call. Which will fall the least? Current yield. Which yield will not change? The interest rate on the bond will not change. Nominal yield is unchanged. Now, I could ask all sorts of questions about the relationship of yields to one another. An example, yield to call, is that more than or less than yield to maturity? Looking at the picture, yield to call would be less than yield to maturity. Yield to maturity, is that more than or less than current yield? Again, looking at the picture, yield to maturity is less than current yield, but it is more than yield to call. So this is how I could explain the relationship of yields to one another. Draw the picture and look at the picture. Now let's take a look at the seesaw and see what happens if interest rates were to go up. Interest rates have gone up since the bond was issued. Well, remember, bond prices have an inverse relationship to interest rates. So if interest rates go up, bond prices go down. Bond is trading for less than par. Bond is trading at a discount. What happens to my yields? Well, the nominal yield is unchanged. The current yield will go up, the yield to maturity will go up, and the yield to call will go up. Now, which of those yields will go up the most? Yield to call. Which will go up the least? Current yield. Which yield will be unchanged? Nominal yield. Now let's take a look at this, understanding the relationship of yields to one another. True or false? Yield to maturity is lower than yield to call. That's true. True or false? Current yield is less than yield to maturity. That's true. True or false? Nominal yield is greater than yield to call. That's false. Nominal yield is greater than yield to call. That's false. So use the seesaw to understand the relationship of interest rates to bond prices, and then use the seesaw to understand the relationship of different bond yields to each other.